Hey everyone, welcome back to Corporate Decoder, the place where we take boring corporate reports and turn them into something you can actually understand. Today we're diving into a report that's a bit like a corporate makeover story, with a few twists you might not expect. Trust me, you will want to check this one out. There were some interesting changes. This report is about the Putnam ESG High Yield ETF, or FIDE, for the year ending April 30, 2025. We'll see how the fund performed, what it invested in, and how it's changed over the last year. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss all things finance with fellow nerds that also are into this kind of stuff. First up, let's talk about costs. How much did it actually cost to invest in this fund? For every $10,000 you invested, it cost you about $55. That's like paying 0.53% of your investment in fees. Keep in mind that the small number reflects some fee waivers, meaning it could have been higher. These are costs you pay annually that chip away at the amount your investment really gains. Now let's dig into the performance. Was this fund actually any good? For the past year, the fund returned 8.16%. It compared its performance to the JP Morgan Developed High Yield Index, a benchmark for high yield bonds, which returned 8.09%. So it did slightly better. It is important to be careful about the financial numbers that companies report because, as everyone says, past performance is not a guarantee of future results. 1. The riastuwank ek anduvi of future results. 3 come the ups and downs for key contributions. The investments that did well were underweight positions, meaning less money was allocated in energy, retail, and consumer product sectors, picking better BB and B rated securities and overweight positions that were in charter communications. What hurt the fund's returns? Positioning less money into telecommunications, food, and beverages that underperformed, as well as cable companies. Furthermore, underweight positions into CCC rated securities, which are very junky bonds, and Altice France didn't perform well. How did the fund perform over the last 10 years? Well, let's note that this fund is barely 2 years old, having been started in January of 2023. Over the past year, the Putnam ESG High Yield ETF had a return of 8.116%. Since its start, that average is a bit lower at 7.43%. As you know, the past isn't a crystal ball, and what happened before doesn't tell you what will happen in the future. To give you some comparison, the JP Morgan Developed High Yield Index returned 8.09% over the past year and 8.35% since early 2023, showing the opposite behavior because it performed better historically. Okay, some quick stats. The total net assets of the fund are $179,674,656. The management fee paid based on a unitary fee was $849,074. The portfolio turnover rate was 36%, meaning that the fund changed its holdings actively during the year. Now, onto what the fund actually invested in. What sectors did this ETF have the most exposure to? The majority, nearly 86% in fact, was in corporate bonds and notes. That massive percentage is then sliced into these sectors listed from highest to lowest. Consumer staples at almost 23%. Capital goods at 12%. Healthcare follows that slightly under. Communication comes in at about 10.5%. Energy at roughly 8%. Consumer finance above 6%. And finally, gaming and lottery at 6%. This means this fund is mostly consumer stuff and has big exposure to communications as well. One time for some how has the fund changed moments, it's a bit of a long and complicated one. So Franklin Templeton acquired Putnam Holdings in January 2024. As part of that deal, Putnam Investment Management, the fund's advisor, became a subsidiary of Franklin Templeton. In July 2024, Putnam Investment Management transferred its contract to Franklin Advisors, who ended up also rehiring Putnam Management as a sub-advisor. Additionally, Peel, another sub-advisor, merged into Franklin Templeton Investment Management Limited in November 2024. Yes, this is dizzying. If you want all the juicy details, the report directs us to check the fund's prospectus for more info. Keep in mind these are a summary of the changes since May of 2024. Alright, let's jump into the financial statements and see exactly where the money was. The fund had investments in securities valued at $167,247,753 in affiliated issuers and $9,487,953 in affiliate issuers. The total assets were $181,180 ND. The The net assets, which is assets minus liabilities, came out to 117,996 to 174,656. They had a payable for compensation to the manager of $78,102. Now let's look at the operations, specifically what money did the fund make and how. The total investment income was $11,234 and $334. That money is from interest and dividends, the primary way this ETF makes money. The compensation of the manager was $877,944, but this was reduced by fees being waived and reimbursed of $28,870.89. Fees waived and reimbursed that reduce the total expenses help make the fund more profitable and efficient overall. This increases its attractiveness to investors who need the most bang for their buck. The total expenses came around to $849,074. The net investment income after expenses was $10,385,260. Add on top of that their total net realized gain of $662,648 all, and change in appreciation for $206,298 AL for additional profit on their holdings. The net increase in net assets resulting from operations was $11,254,206, basically their profit line for the year. How has their net asset changed year over year? Well, in the year 2025, they had a net investment income of about $10 million. In 2024, that number sat at nearly $8 million. That means they are doing about 25% better year over year just on management. That has to do with better decisions from managers and higher interest yields from securities. Not bad. It is important to remember that the numbers they choose to include can be misleading. So let's see what liabilities were chosen in 2024. The proceeds from shares sold are approximately $52 million. In 2024, it was just under half of that, around $23 million. That means they have far more investment because people are buying into it or they are selling to reinvest. All these things we talked about contribute, and we can see here that their total assets went from 127 million to 179 million to 305 million to 3.5 million to 3.5 million to 3.5 million. Now let's do it the financial haiku. What does the story of a share tell? The total return at net asset value was 8.160. So what does it all really mean? This fund behaves like a well-diversified fund with a competent manager. It had decent debt yields overall, as well as some interesting insights to profit on the portfolio. Its largest holdings in communication might concern people, but as long as management can account or hedge the risk, it serves the purpose for the ETF. I think it would be interesting to keep an eye to see how the investments change within the coming years. I believe it does what it says, and its numbers reflect that. Alright, that's a deep dive into the Putnam ESG High Yield ETF's annual report. What are your thoughts on these fund changes in performance? Do you agree with the fund's choices, and where do you think these numbers indicate the company will head? Drop your insights in the comments below. It takes a village of good minds. If you found this analysis valuable and easy to digest, hitting the like button really helps, and subscribe for more corporate decoders straight to your feed. Don't forget to check out the Discord in the description. Thanks for tuning and your attention. It is really appreciated. This isn't investment advice, of course. I'm not responsible if you lose money.